Alrighty, welcome back everyone to another episode of the Wise Wealth podcast. I know it's been greatly anticipated. We've been on a little bit of a break, but
yeah, you and your exams.
Yes, I am the one to blame.
It's hard to believe, eh?
Yeah. Anyways, right off the bat, I just want to call out the elephant in the room. This incredible setup we got here. So, what happened?
Hey, we're trying to make incremental improvements here. The Wise Wealth podcast is going to keep investing money, and we'll keep trying out new and wonderful ways of improving the audio and the video, and it's going to be an ongoing incremental improvement.
Yeah, well, I know when I came down and saw it for the first time, I was blown away. I feel like I'm in a real, well, it is a legitimate studio now.
Yeah, and we've got the books behind us, all the great ideas. So I think this will be great inspiration for future podcasts.
Yeah, it's going to be good. Alrighty, so the agenda for today. So we're kind of going to start out with some topics surrounding goals. I'm going to share a little bit about my 2024 goals. There's a couple that I've kind of, if everything goes to plan, I will be attempting them in 2024. And then you were going to talk about some strategies around goals, some kind of an acronym to kind of think about with goals, and then also some retirement traits to cultivate.
Yeah, so we're going to talk a little bit about what the research says about traits that lead to a happy and really satisfying retirement. So we'll share those traits in this podcast as well.
Then we're going to move into a topic that actually I've been talking about this in business school forever, which is the idea of like shareholder primacy versus stakeholder theory, which is, I think, a fascinating conversation. Recently in my finance capstone course, we watched two videos from a movie called Other People's Money. And there was two speeches from that movie that kind of encapsulated the two competing ideas quite well. And so I thought it'd be a fascinating conversation for us to kind of react to those two speeches and kind of give our thoughts.
Thoughts around matching theory with reality. So we'll talk about that a little bit.
Yeah.
So I think it's a really interesting debate, and
and
we'll cover it off, give our 2 cents worth. And please feel free to give your 2 cents worth as well in the comments underneath the video.
And then finally, we're going to cover off a little market update. I think you had a couple points to cover on that.
Yeah, I mean, since our last podcast, lots has happened in capital markets. We'll give a bit of a summary on that. And as well, in terms of the different sections we'll be talking about, we'll put some chapters in the video. So if you want to go back and forth the different topic areas we covered today, please feel free to do that. One last thing as well. We've talked about this in past podcasts, but hey, if you've got some questions, if you've got some topic areas you want us to take a look at, I know many of you who are watching these videos are probably getting close to retirement, but many of you might be younger. So when you think about finances and money, give us your questions, and we'll try to cover those questions in future podcasts.
Right on. So you want to take it away on the first part there?
Yeah. So let's we'll talk about this concept of SMART goals, and I think that it's a really, really important topic, given that we're in 2024. So think of all the people, Josh, that have set New Year's resolutions.
Yeah.
How many of those resolutions actually happen for people?
Yeah, not many.
Not a lot. So I'm going to cover off an old concept, but it's a concept that it works. And I think if you're really engaged in your work and it's important you set goals, or in school like Josh, I mean, goal setting is almost a natural process in some ways. You're almost forced to do that in the context you might be working in or in school. As you get older, I think sometimes you have to be really intentional around setting goals to keep some excitement going in terms of your life and expectations and things you want to do. So I thought it'd be a good topic, particularly given that we're turning into a new year, 2024. And so what can we do to make sure that we increase the probability of achieving our goals? So the idea of SMART goals, maybe some of you have heard the term. And what does SMART stand for? It stands for specific, measurable, achievable, relevant, and time-bound. And when you think about different goals in your life, if you can focus on SMART, you're going to have a better chance of achieving those goals. So S, SMART, specific. Specific. If you can be really specific about your goals, I want to be in better health this year. Well, what does that actually mean? Well, maybe that means I'm going to lose 15 pounds, and I'm going to do that for the following reasons, and it's going to be a very specific goal that you want to achieve. Measurable. Again, make that goal measurable. What does it look like? What activities are you going to do every week? Can you check off the boxes to demonstrate that you've done those things? Achievable. Sometimes we set goals that are just crazy goals. I think when you look at different books, aspirational books around goals, there's this idea of setting big, hairy, audacious goals, and I think there's a role for that. But in terms of incremental or improvements in our life, make it achievable. That if you actually follow through on specific items in your task list on a consistent basis, you have a high probability of achieving that goal. And then relevant. Why are you doing it? Why is a goal important to you? So again, I talked about the one related to health. Maybe it's losing weight. I want to do that so I can have energy to do things with my grandchildren or with my kids, or have energy for work or different activities that I want to be involved in. And then the last one is time bound, making sure that you've got specific dates or deadlines in that goal that you're trying to accomplish. What are those benchmarks you're shooting for on a regular basis? So just think SMART. We got specific, measurable, achievable, relevant, and time bound. And I know that this guy is going to talk about some of those goals. He knows a lot about goal setting. So what, 2022? When did you do Ironman? 2022. So
yeah.
I had a lot of fun with Josh in 2022. We kind of hung out together a little bit. He went to Mont Tremblant and did a half Ironman competition. He trained for months to get ready for it. And then that summer, he went to Penticton and did Ironman Canada, which is extraordinary race to both participate in and also watch. So what's going on for you for goals?
Penticton actually it was cool because it was the first year back after a couple years they didn't have the race there.
Yeah.
They heard I was coming. No. But yeah, so goals are a funny thing. In my case, sometimes they can kind of be really surrounding the person you see yourself trying to be, right? So in my case, I'd been really active, really into like sports when I was younger, and then there was a period in high school. I played a lot of sports, but I really had no goals. Like I was playing hockey to play hockey. I was just hanging out with friends. That was pretty much it. And I think there was a little bit of a part of me that missed the competitive nature. Although, I mean, Ironman, you're racing yourself, so I wasn't very competitive. But part of me missed the challenge in goals that were really, really hard. And I think a lot of the goals that I had before were just quite passive. I didn't have to really push myself for. And so I know I went through a lot with that one, doing Ironman. And
You want me to share? Like, not everyone knows what an Ironman is. So what are the distances for
yeah,
Ironman?
so for the half Ironman is just half of the full, right? So a full is 3.8K swim, 180K bike, and then a marathon, so 42.2K. And for me, the hardest part was Penticton. It was so hilly, right? And I'm not used to that. I also had a couple mishaps. I had to switch out my bike 2 weeks before, which caused some stress. And also it was a hot day. It's a really hot day. So yeah. But in terms of my goals for this year, I went through a bit of a running phase last year. I did a couple ultra marathons, and the one thing I liked about long distance running was that I found the margin of like the chance of you failing were kind of low because all you had to do was finish. It wasn't like I rarely had time goals. So this year I thought, okay, well, why not challenge myself, put myself in a position where it's kind of going to be easier to fail. And so I'm going to go, one of my biggest goals, I've kind of recently committed to this idea of doing a 3-hour marathon. Partly because a lot of people I watch on YouTube have done that and then gone for like faster times, like 2:40, stuff like that. And so that's my big goal for 2024. So I'm probably going to do a race around end of May, beginning of June. But yeah, in terms of like SMART, so specific, my goal is very specific. A 3-hour mark is as specific as you can get. So if it's 2:59, I'm happy. Ultimately, I want to make Boston, which is you have to go into 3 hours, but it could be the cutoff could be faster than 3 hours for that. And so if I'm under 3 hours, I'm happy. What were the other
measurable?
again, quite measurable. I mean, it's a time goal. And then I guess
And each
workouts
week
need to be
each
measurable
week,
as well, right?
Yeah.
What's the next one? Smart
Achievable.
That one's relative. Is it achievable? Well, I hope. I think it will be. I think I have.
Oh yeah.
I couldn't do it now. So theoretically, in 4 months, I think I'll be able to do it. I just had a progression a run where it was like 2 miles at 7:15 minutes per mile, 2 miles at 7, and 2 miles at 6:45. And for the race, I need to run at 6:45, a little bit faster than 6:45 minute per mile for 26 miles. And it was a big kind of an ego check where I was like, holy smokes, I'm struggling to keep this up for 2 miles. So, I mean, theoretically, in 4 or 5 months, I'll be able to keep that for 26 miles. But yeah, every week.
And why is the goal relevant? Like, why in the world are you doing this goal?
I've watched too many running documentaries, and so I've been manipulated into seeing this as a positive thing. Yeah, no, I need something physical, because I have goals in school with work and stuff like that, but I need something physical, so it kind of keeps me in check. And so there's that whole holistic goal setting conversation there. And then what was the last one?
Of course, time bound, right? So you got
Yeah.
very specific things each week, each day,
Yeah.
over the next few months. And again, when is this race? The first real race you're doing?
Well, I'm probably going to do the Manitoba Marathon, which is, but I'm thinking I might do
That's June.
Vancouver
Yeah.
a little bit before that. I was going to do Fargo or Vancouver,
Okay.
but Fargo was like 2 weeks before, or sorry, Fargo or Manitoba Marathon, but Fargo was 2 weeks before.
Okay.
So it didn't make any sense because in 2 weeks I'm not going to recover to be able to race again.
Yeah.
So I might do Vancouver and then Manitoba, or Manitoba and one later. But if I don't get it the first time, I can do another marathon somewhere.
That's perfect. That's
Yeah.
exciting.
Yeah.
Yeah, 2022 is exciting for me because I kind of live vicariously through Josh's triathlon activities. I remember Penticton was great because back in 1997 and 2000, actually 1997 and 99 actually, I did Ironman Canada. So he was just a little guy. Was he even born yet? No, he wasn't even born yet. He wasn't even there. Two of my kids were there for it. And then my last Ironman race was 2000, so Ironman Florida.
Yeah.
So it's kind of cool seeing Josh.
Ironman Canada is Penticton Ironman.
Yeah, so it was Penticton, same
Yeah,
place,
same
same
place.
location. Okay, anything else on your goals?
No, I think, I might give little updates here and there when we do the
That'd be good.
podcast, see how it's going.
Love to hear it.
Hopefully the update isn't injury. but-
Excellent. Well, maybe I'll segue into the discussion on traits for successful retirees. And these are actually goals that you may want to take a look at in your own planning. So we're talking about the SMART goals. So what are you thinking about for 2024? Again, I would encourage you, it may not be relevant for most of you out there, but sometimes as we get older and we transition into retirement, we get a little bit in a rut. And so what I'm going to try to encourage you to do is look at that SMART goal framework and begin thinking about different areas maybe you can kind of really lean into. So what are the character qualities? There's 5 of them of successful aging. And so the first one is connectivity, really relationships, right? Are you connected with people? Do you have a rich network? Are you intentional in that area? I'll give you an example. Sometimes when it comes to our relationships, they're just kind of a given, right? In the work context or the school context. And as you transition into more of a retirement context, relationships change quite a bit. So as you look at your relationships and people around you, are you cultivating those relationships? So successful retirement is about that relationship cultivation. The next area is challenges. Okay, are you challenging yourself physically, mentally, intellectually? Again, are you in a rut, or are you actually thinking about things that you can do to improve different aspects of your life? So challenge yourself. The next one is curiosity. Are you curious? Are you learning new things? Are you trying new things? And again, if you are fostering curiosity as an attitude, then it's going to be a better retirement journey for you. And tied to curiosity is the next one, which is creativity. So are you trying creative things? The arts, painting, different aspects of creativity, photography. And then you've got the next one, which is charity. Are you using your time, your resources, your abilities to make a difference in the world, whether it's for your grandchildren, for your family, for your community? So connectivity, challenge, curiosity, creativity, charity. Those are great traits to really focus in on, and those are traits of successful retirees and successful aging. And that's my thought about this area around the successful traits. So I think you wanted to give us a bit of an introduction to this next topic, which is stuff you're learning at school, which will create, I think, a really interesting debate for us around finance.
Yeah, I just think this topic is fascinating. So I think it was my last class a couple of days ago. We watched two of these clips from a movie called Other People's Money. So it's a cable company. So it's a meeting at a cable company shareholder meeting, and the owner of the company, I think he's the owner, or like he runs the company, is basically making the argument that although they're in a tough situation, it makes sense to kind of power through it, and there is going to be infrastructure that's going to help out the company later, and people are going to need cable and stuff. He was making that argument. And then another guy, referred to as Larry the Liquidator in the clip.
Larry the Liquidator.
Yeah, kind of is the financial bottom line guy, right? So he's coming in and saying, you guys should sell, and you're beating a dead horse right now. It's the company's dead. And yeah, so it's these two different ideas of, I think, so the two fundamental theories behind this is whether or not the only thing you should look at is the financial situation. So, are the shareholders going to do well if you sell the company, or are they going to do bad, right? And then this other theory, which is the stakeholder theory, is the idea of there's many stakeholders involved in a company or a corporation. There's employees, there's the environment, there's all sorts of outside people that are going to be affected if a company sells, and so sometimes those interests are conflicting with the interests of the shareholders.
Yeah.
And so if you, as a board of directors or something, like if you're only thinking about the shareholders, that's going to maybe go against the environment, go against other people, right, or employees.
Yeah.
There's unbelievable nuance to this, and I think ultimately it's not like it's obviously not a black and white topic, but.
And so I think we're going to show a video.
Yeah, we're going to show both clips are like 4 minutes. They're just the two speeches. And I think it would be entertaining and fascinating.
So what I would encourage you to do is debate it around the kitchen table, around the dinner table. This is a really relevant topic. We've seen it in action in the media and newspapers over the last little while. So again, to summarize what Josh has said, what's the role of a publicly traded company in terms of generating profits? Are those profits really to be generated for the shareholders of those companies? And it's not their responsibility to be social activists or making a difference in the environment or equity, social equity, and those kind of topics that are really relevant in our society today. Or do organizations have a responsibility to be engaged in those topics? And we'll kind of debate back and forth at the end of the video. And I'd encourage you at work, at home, whatever, debate it, because it's a very relevant issue. And it's going to inform how you approach your investment portfolio going forward.
Oh, absolutely. Yeah. All right. So let's take a look at these.
So we weren't infringing on any copyright laws. We couldn't include the video actually in this video. However, you go to the show notes, there's a link to a couple of videos that show some key clips to illustrate the point that we're talking about. Essentially, Larry the Liquidator is basically specializes in hostile takeovers, companies that are distressed. He orchestrates the purchase and sales to make a quick buck. The company is arguing that there is great value in the company and intrinsic value, and that it shouldn't just be about liquidating and making money, that companies have a bigger role to play than just that. So I would encourage you to actually go to the links, watch those videos. That'll stimulate conversation. So the conversations that Josh and I have after this video that we're reflecting back and forth were triggered by the video content itself. It'll still make sense when you watch this video and listen to our comments, but the backstory is hostile takeover, Larry the Liquidator, and you've got the company trying to argue for its ongoing existence. And it'll be very, very timely, because we're going through the same kind of debates often with corporations in our current reality.
All right, so I don't know if anyone saw, but that was Danny DeVito playing Larry the Liquidator. In the movie, actually, he is one of the love interests. So it's a rom-com, a finance rom-com. And
was that Gregory Peck who was
Yeah.
arguing for the company?
yeah, I
To
believe
Kill a
so.
Mockingbird. Okay.
But it's just funny seeing Danny DeVito in as the love interest in a movie.
So we'd love to hear your comments about this. This is a great setup for the natural conflict that happens. What is the purpose of a business? Is it to simply maximize shareholder value for its shareholders? Or are there other purposes that businesses have a responsibility to be involved in? Now, obviously, we'd all agree that they shouldn't be raping and pillaging the earth. I mean,
Yeah.
there's some basic things we probably could all agree on. But is it a responsibility for a business to worry about some of the things that owner was worried about? So it's an interesting discussion. What are some of the points that came up in your discussion in class?
Well, we had a vote.
Okay.
So people were arguing whether they were in favor of Larry and then the business owner. I don't know. Like, I think depending on the situation in the company, you could go either way. And it's also one of those things where it can be nuanced. So, for example, often when you think about it, you think, okay, well, if they sell the company, that's bad for the employees and it's good for the shareholders theoretically if they're going to make money, right? But often that's not actually the case because employees often might get bonuses or packages when they leave. So there's conflicted interests. It's never black and white. So even though often when you see these like diagrams, it's like showing, the interest of the shareholder versus the interest of like suppliers, consumers, customers, employees, like stuff like that, like they're conflicting. Many times, like they're kind of like intertwined. And so that's why it's never black and white. In this situation, again, it's tricky because what I said in class was depending on where the company is in its life, I guess you could say, often there's periods of it not being profitable. So one example was like tech companies are often not profitable for a long time when they start out, right?
Yeah.
And so you kind of have to believe in the prayer. You kind of have to you have to side with the idea that they might be profitable, and most of them won't be. So if just purely logical, I mean, the chances are not in your favor, right?
Yeah, and I think what's interesting is, as part of this discussion, I didn't have a chance to talk to Josh about this, but I think in the investment business of late, there's been this movement, principally led by BlackRock, probably the largest asset manager on the planet. They manage about $8 trillion. And Vanguard to a certain extent. So there's this movement towards having corporations as vehicles or extensions to make a difference in the world.
Yeah.
So whether it was the greening of the economy and the planet, whether it was equity and social justice issues within corporations, how HR was handling hiring practices, compensation. And so many of those things were not traditionally the domain of corporations, right? They were getting more and more into more interventionist roles. And just recently, BlackRock, and I think Vanguard really initiated this, they found that it was actually getting in the way of being fiduciaries to their investors. In other words, they weren't convinced that pursuing those policies actually made a meaningful difference and was actually hurting investment decisions. That doesn't mean that they thought that those issues weren't important, but I think the question was it the role of these corporations to do this? Or did society, governments, and social policy at a community level or a national level have to be driving those decisions? And then businesses would just operate in that context. And I'll give you a few really good examples. On the one hand, I do believe this debate's relevant because over the last 60 years, we've seen the following kinds of things happen. We've seen stock options given to executives, right? Executive compensations just become stratospheric when you compare to where it was. The wage differences between the average, employee on the line and what executives were making. Yeah, there was a difference, but it wasn't like a magnitude of 300-fold or whatever. It was just more normalized. You've got corporate welfare. So you've got unfair practices where governments will favor some industries over the other and give them, tax breaks and different benefits. Is that fair? Should governments be playing a role where there's winners and losers because of certain policy decisions? Globalization. This is a really important one. Is globalization where we offshore all kinds of work, right? And the reason that happens is
It's cheaper.
cost. It's cheaper,
Yeah,
right?
yeah.
And so whether we know it or not, when we walk into Walmart or Target or other kinds of stores, and we're really happy about the low prices that we pay, right? That's because of globalization. That's because of offshoring. But it does have an impact on our country. You look at Canada, the U.S., we've been shipping those jobs off. I'm not saying we shouldn't, but there is actually a policy decision and a discussion that should be happening. Love to hear your comments, on this particular podcast. Would you be prepared to pay more for a good or a service if that work was being done here, so that work, employment, and economic opportunity might be protected? Or would you say, no, let's offshore those low-skilled jobs because we believe over time that high-tech jobs or other service jobs will replace that? Is that true? Maybe, maybe not. But sometimes we don't connect the dots between maybe I'm prepared to pay a little more to make sure that these organizations can stay in my local area or in my country to create employment opportunities and a certain kind of lifestyle, right? So
Yeah.
is that a debate that needs to happen? I'll give you a good example, Josh, and I'll be quiet and you can give some feedback. But a great example is, again, you have stakeholders, and I've seen this the last 50 years where historically defined benefit pension plans were very common across the country. So
We
if you
talked
look,
about that after in class. Yeah.
if you look at the coverage of defined benefit pension plans, which are, really Cadillac gold-plated pension plans for employees, a much higher percentage of employees across the country were covered by defined benefit pension plans. Now, partly because we had much larger employers, you had multinational, national organizations, very large organizations that could afford to deliver on that. So you had government, and you had large corporations, large union organizations that negotiated those benefits for their employees. When you look at the landscape now, because most employment is created by small business, those businesses, first of all, really don't have the financial resources to deliver on those kinds of pension plans. But there were other factors going on, right? So if you're an employer and you've got a defined benefit pension plan, and let's say there's a surplus in the pension plan. Let's say the markets have been really good and the actuaries have sharpened their pencils and they've calculated that there is an actuarial surplus. There's more money in that pension plan than is required to honor the pension commitments to the annuitants who will eventually get a pension. So what do you think was happening? Well, employees who thought rightfully so said,
They want it.
who gets this surplus? Is it the companies? I put money in. They put money in, but they're investing the money. Ultimately, really important thing to remember is that on a defined benefit pension plan, the liability stays with the employer in terms of any future unfunded liabilities. And so what the corporations would argue, or the businesses or governments, they'd say, yes, we're in surplus position now, but we may not always be in surplus. And we want to have surpluses for those days, those rainy days that we need to have surplus. So when you go into deficit because of market downturns, we've been able to manage that as good stewards so that pension plan is fully funded.
Yeah.
Right? And so it created this adversarial, debate back and forth, and many times surpluses got paid out. Employees wanted to have access to surplus, but when the corporations or businesses said, okay, if you get access to the surplus, will you pony up with us to deal with the deficits when the deficits weren't there?
They
And
didn't
what do you
want to.
think they said?
No,
They really didn't.
I don't want to do that.
Right?
Yeah.
So that's where you get into these interesting debates. And as a consequence, you've seen this winnowing away where stakeholders couldn't really agree and felt that, yes, I want the benefit as an employee group, but I'm not prepared to take on the liabilities and the downside. And so it can be very complex, but that will be one example of, one of the issues that comes up from time to time.
Yeah, no, that conversation is fascinating as well, because we had another case that was about that idea of like there were managers for this pension and so they pulled out of oil and gas, and then their portfolios kind of suffered a little bit because of that, and then they thought not oil and gas, sorry, tobacco, and tobacco actually didn't do that badly, and they missed out on many billions.
Yeah.
And then they had to make a decision whether they invest back into it, and so they had a vote on like whether or not they should do that. Yeah, I think it's a fascinating conversation because the interests of what the people want often conflict with what will make the most money, and so it's kind of this back and forth on what's your bottom line, right?
Yeah. I'll throw out one other topic, and we can close this one. Minimum wage laws.
Yeah, yeah.
So is that a good thing? I think our natural impulse will be, yeah, like $15 an hour or 16 or 17. Of course, people should make that. And yet, in the real world, do minimum wage laws actually help employees? And people don't sometimes think through the implication of that. So, who in the economy is typically making minimum wage? Is it someone who's been working for an organization, even a fast food franchise, for 15 years? Are they making minimum wage?
Yeah. Well,
it's
tricky because they
right?
kind of changed the wording, right? Because now what's a livable wage, right? They want a livable wage, a livable minimum wage. When I don't know, it's a controversial take, but should I be living the rest of my life off the minimum wage? I don't know.
I think, and again, in the comments, you can share your feeling. I think if you really drill down to the data, it's, those high school students, first-time people into the workforce, they're getting paid minimum wage. Anyone that's been working for a while probably is not getting paid minimum wage on average. And often what happens is that companies or organizations will look for ways of leveraging efficiencies. So if minimum wage is not sustainable for them from a cost standpoint, what happens? When you walk into McDonald's, look at the kiosks. It's like an ATM machine. You walk in, and how many people use that machine now to order their food?
Yeah, you
right?
don't need people at the counters.
Yeah, and so it's tricky, right?
Yeah.
In terms of what we think, even rent controls. We think rent controls, that's a good thing, and yet study after study confirms that rent controls actually create dysfunction in the real estate market, right?
Yeah.
It actually bids up the prices. It doesn't help the situation. So it's complex, but give us your feedback on, do organizations have a social responsibility? If they do, up to what level? I completely get people frustrated because social welfare, exorbitant compensation of executives, concentration of power, offshoring, those are all things that have been negative to a certain extent. So people get frustrated, and rightly so.
Yeah, this reminds me, I think I'm going to butcher this quote, but Thomas Sowell said there's no solutions, only trade-offs, right? So
Yeah.
I think that encapsulates this whole conversation quite well. I think you can make the argument for both sides well. But lastly, back to the clips for a second. We could talk about this forever, but I think when looking at the two speeches, you have to just get into the points that the speakers actually made. So, for example, on the guy who owns the business, right? His point that they will probably get infrastructure later that's going to help their company, and that if they just hold on for a little bit, that they can make a comeback, right? And then obviously Larry was like, no, fiber optics, all the new technologies. It's not going to be like that. So I think both sides like paint a narrative, but I think we can apply this in any situation, but if we look at the specifics, okay, is that true, right? Is there going to be infrastructure that's going to come, that's going to support our company? Or is it just technology is too good, right? I think if you get wrapped up into the emotions of either side, I don't think it really serves you. You just have to look at the arguments they're making instead of like how good a speaker they are, all those different things.
Yeah, exactly. So give us your comments. Look forward to that.
Right on.
Okay.
Alrighty, moving on. I think the last piece we're going to cover today was the market update. I know you had a couple things you want to share about that.
Yeah, I know capital markets and market swings and what's going on in the market's not everyone's cup of tea, but we want to make sure that we cover off some high-level comments around capital markets when we do this podcast. So for those of you that enjoy this area, it's going to be maybe light, but at least we'll give you a few highlights. This is really going over the last couple of weeks, and we're fortunate. We have CI Global Asset Management that works with us to provide research, and of course the portfolios that we manage leverage off that research. And so these themes, when we talk about them, create opportunities for investors and for the money managers that we use for our client portfolios. So let's do a bit of a recap, kind of going over the last a couple of weeks. So the first thing is Canada has experienced, if you look at employment data, which is a really important kind of benchmark that we focus in on, employment's kind of flattening out now. So we're seeing, the unemployment rate at around 5.8%, and a bit of a slight increase to hourly wages, but we're seeing kind of a bit of a plateau. Now in the U.S., there is stronger job growth, and that has implications for this ongoing discussion around recession and whether recession is actually going to happen over the next little while. We've experienced the last couple of weeks a bit of a sea change, at least the last 2 weeks, around interest rate policy. So up until fairly recently, Jerome Powell, the Fed chair, has been pretty hawkish about keeping rates higher for longer in the U.S., but just recently they've taken a bit more of a dovish approach to interest rates. So the expectation is, certainly by the markets, that interest rates are going to fall. And certainly if you look at Canada, interest rates are going to fall. We may even see, in the first quarter of 2024, the first reduction in interest rates. We've also seen a little bit of a weakness in the service sector in Canada, and a bit of a reduction in the Purchasing Managers Index. And that index really measures sentiment or optimism by purchasing managers who are buying the inputs for manufacturing. And that particular index dropped to 44.6, indicating they feel there might be continued contraction. And so we still see a little bit of weakness in that particular area. And the other big picture issue has, of course, been the Red Sea, and issues around the Houthis and transportation and aggression in that particular area. This is going to have a bit of a drag on economics for sure, and so as we kind of migrate through that. Now, all these themes, slower retail, consumer growth, economic growth, means that portfolio managers will begin to position assets into non-cyclical stocks that will be more resilient over this period. Now, the other thing that we have been following around this area is really, if you look at, in spite of all that news, investor optimism has been running pretty high recently. We see U.S. equities might be vulnerable to downward pressure, but if we look at the last few weeks now, we've seen a pretty extraordinary rebound to capital markets. Now, again, that rebound has been driven by this expectation that interest rates are going to fall. And so we've seen both the bond market as well as the stock market rally pretty significantly. We just picked this comment out from one of our portfolio managers, and the comment was, according to the American Association of Individual Investors survey, bullish sentiment rose to 48.6% last week, above its historical average of 37.5%. The positive outlook on stocks has been largely driven by solid evidence of falling inflation, resilient economic growth, as well as a prospect that the Fed may be able to cut rates this year. So not everything's perfect, but certainly there's an expectation that we'll continue to see likely some momentum in capital markets over the next little while.
These changes in these indices and the individual investor survey, does Canada follow the U.S. often in like the direction the U.S. is going, or are they quite directly correlated? Or
there is some connection, Josh, but what I would say is there probably is going to be less correlation going forward. If you looked at the Canadian market, one good example is interest rates.
Yeah.
So in the U.S., particularly for retail consumers, they have these like 30-year mortgage that people can take out,
Yeah.
right? So these recent changes to interest rates don't affect them as much. So in Canada, we've got 1 through 5 year mortgage terms, and so you've got a lot of money coming due over this next 1, 2, 3 years at probably higher interest rates. And if you look at the Bank of Canada, one of their big concerns is how destabilizing that might be to the economy. That's one of the reasons why the expectations that rates will be pushed down probably pretty aggressively in Canada, because of our mortgage situation where a lot of money is rolling into higher interest rates. And that's not the case in the U.S. I'll come back to some other data in the U.S., but a big one is those 30-year mortgages, which kind of create a bit of a defensive moat around the average family in terms of interest rates.
yeah, that makes sense. I guess the systems are quite different. So
Yeah, exactly. So I think that interest rate piece that we've been talking about for a while is really manifesting itself. So in our previous podcast, we thought that rates would likely at some point peak and at some point come down. Although they haven't come down dramatically, inflation has, and clearly the market is saying rates are going to come down over this next several months. When it comes to the overall economy right now, not only has the consumer price index dropped significantly, we have to go back. If we go back to, let's see, June 2022, 8.1% the CPI was tracking. And if we look at September, it's tracking at 3.8% annualized last year, and we're tracking about 3.1%. So definitely inflationary pressure is coming down, and that's going to give the Bank of Canada, I think, some room to reduce rates. We continue to talk about recession. I think there's a bigger chance of recessionary pressure in Canada, certainly, but we're not convinced yet that recessionary pressure is going to hit the U.S. anytime soon. There's a chart that we'll put up on the screen, but basically it takes a look at the major sectors of the U.S. economy. If you look at the broad S&P 500 and the last earnings that came out, corporate earnings in the U.S., 82% of the companies reporting had earnings above expectations. So, we had, 4% match expectations, 14% below. Well, if you've got an 82% of companies exceeding expectations, that's telling you that we're not anywhere close to recessionary territory as it relates to the U.S. So there's weaknesses definitely. If you go to China, the real estate market, that's weak. Manufacturing's weakened a bit. If you look at Japan, there's optimism by portfolio managers. There's good opportunities from an investment standpoint. And if you look at different sectors, one of the portfolio managers we use said this. He said, we remain constructive in the technology sector as earnings are stable and new technologies such as generative AI and high-speed computing are driving growth in the U.S. economy. And it's a significant driver. They think that in the tech space, there'll continue to be above average performance for investors, and that sector will likely remain pretty resilient in spite of higher interest rates. They also say that when it comes to the bond market, we've probably seen a good level of the play in the bond market. So the bond market still has, decent potential over this next little while. We'll see interest rates likely fall. We might see a little more price appreciation in bonds. But certainly the U.S., if you talk to most portfolio managers, they view the U.S. as really the place to be for bonds because they think there's more room for a bond rally because rates will probably remain higher for longer. And then when they eventually go down, we'll see price appreciation in bond markets. You're seeing portfolio managers also moving more and more into corporate debentures, feeling that they can pick up some additional yield and price appreciation in bonds there as well. And the last thing I would say is I've been talking to a few clients about just the practical reality for the U.S. One of the reasons that there's a feeling that rates will come down, even if the inflationary pressure remains, which we don't think it will, but there's huge pressure on the Fed right now because interest rates have been so low for so long, and we had all these U.S. Treasuries being renewed at very low interest rates. What's happening over the next, 1, 2, 3 years is a whole bunch of U.S. debts coming due, and the Fed's very concerned about that debt renewing into higher interest rates. And if that were to happen, the fiscal situation in the U.S. would deteriorate, right? It'd be very tough economically. And so I think they want to see rates come down. So as bonds mature, they're rolling those bonds back into lower interest rates than what we're seeing right now. So lots happening. There's opportunities in tech, corporate debentures, the U.S. market, the Japanese market, and rest assured that our asset managers are fine-tuning portfolios to leverage those opportunities that will be arising over the next little while.
Right on.
Okay.
So I think that's about it for today. I hope you guys enjoyed that. I think those conversations were pretty exciting. I like those conversations, but
yeah, and make sure that you go to the links for the podcast. There's links back to our website and free resources that you can take a look at. And as I mentioned, use the comments below the video to share different topic areas or questions you'd like us to address in future future podcasts or guests. So we'll try to have future guests involved as well that can really add clarity to some of the topic areas.
Yeah, and let us know why we're wrong about our opinions on
Yeah.
stakeholder theory and shareholder primacy. Yeah,
Okay.
let us know why we're wrong. All right, thanks so much for tuning in, and we'll catch you next time.
Take care.